and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice. Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
Good. I'm good. I'm sore. I spent the weekend, at least Saturday, painting one of the properties I'm trying to get ready for rent and quickly reminded myself why I don't often do that.
Yeah, I appreciate that there are pharmacists out there, people out there that want to go out there and do the weekend warrior thing and knock stuff like this out. I did that last summer too, where I painted a rental and thought it would be fun in the moment until I just realized, yes, for me, that's not fun. I love that it's fun for others, not the most fun for me either.
Yeah, and some of the work I like doing, but this was knocking a bar out of the wall that had been there for way too long and repainting a bunch of wood paneling. And I was like, man, this is terrible. I need a pro to do this because this is not turning out the way I want it. So anyway, speaking of professionals, we brought on a professional this week, a professional real estate investor, Senate Eskridge. He came back on episode 26, actually, with a pharmacist, Mason Goodman, and talked about syndications. Well, we decided to bring Senate back on by himself this time to really dive into how does a syndication work? What does a professional real estate investor look like? And just a great fit to talk about all things syndication.
Yeah, it's a really interesting business model too, because as much as it's billed as simple, just having someone to run the deal and someone to invest in the deal, there's a lot of complexities in there. And I appreciate that Senate explained that really well and really clearly. We've also seen this market environment where this kind of rising tide of the market where values are just appreciating everywhere, rents are appreciating everywhere, like everything's going up fast. That rising tide has helped many ships. But I think as a lot of these syndication projects look at like a 3, 5, 10-year horizon, Senate also speaks to how, the market may not continue to boldly increase over that time and how you can protect yourself as an investor from potential corrections.
Yeah, what I really like is Senate's explanation of how to vet not just a deal, but an actual syndicator, the person bringing the deal to you, because that can really make or break it. And so he walks through, if you're going to put your passive money with someone and hope that it grows, this is how you can do that wisely. And I think it's really valuable to people that are looking at syndications as an option to listen to somebody who not only runs syndications, but participates in them himself. And so has seen this from both sides of the table.
Yeah. And I like to, I think it would be easy to be cynical of like, oh, well, this guy's saying how a syndication should run. And of course, he's going to say how he runs his. But he also says, like, don't just take my word for it. And he has some references out there, like a really good book that he references to. So other ways to vet deals and to make sure that if you're going to jump into a world like this, where you're going to park your money with a syndicator for 3, 5, 10 or more years, that you understand the complexity of that, you understand the risk, the reward, and you can do that intelligently.
Well, really glad we got to bring Senate back on the show. And with that, we'll take you guys to the interview. Hey, Senate, welcome back to the show.
Hey, thanks for having me. I'm really excited to be here. I enjoyed the last one and been looking forward to this one for a little while.
Yeah, this is awesome. We had you back on episode 26 with a partner in crime. We brought on Mason, a pharmacist, who kind of introduced us to you and all the things that you do. So, passive investor, syndicator, just incredible story. So maybe for those that missed that episode, maybe fill us in a little bit about your experience in real estate investing and your background.
Yeah, I'll give you the short story.
Sure.
I started off with single family houses like most real estate people. And I was buying houses and just started stacking those up. And then I accidentally flipped a house. Somebody came and offered me some money for it. And I said, sure, I'll sell it. And I liked that big return. So then I was flipping houses, buying houses. And I got up to the point where I had more than 10 units and it just really wasn't scaling at the end of the day. I looked at the cash flow I was receiving and the amount of work that I was have to put in. And I decided to do something different. So I pivoted, went into multifamily, found some amazing coaches and mentors, spent well over a year learning about all the nuances of multifamily and other pieces of commercial real estate, and dove in after that. I've been selling off all of my single family portfolios. I actually have one left. Everything else will be gone. And I'm moving into multifamily and never looking back at single family or small duplexes or triplexes again. All after the big apartments going forward.
That's awesome. And again, very unique, right? A lot of what we talk about in this show is how to get started in real estate investing. And a lot of people like to start with that single family or small multifamily. So this is a great perspective from somebody doing things, a little bit differently, which is great. It helps us all kind of learn and grow. So we appreciate that.
Yeah, of course.
And looking at that, you have a little bit different approach in terms of these larger apartment buildings, right? So you aren't going out and buying like some 70 unit apartment building all by yourself, right? Like when you invest in larger apartment buildings, you bring investors along with you where they entrust you to manage that whole investment. And then you entrust them to bring cash into that investment. And so you create these larger partnerships. Is that right?
Yeah. What I like to say is anybody can go and buy a duplex or even a triplex and go get a conventional loan for it and then go rent it out and be a landlord and deal with the tenants and the toilets and the termites and all those other troubles that happen, right? But it takes a special skill set to buy a multi-million-dollar large apartment building. Not just anybody can go and do that. So what I do is I take people's money, like your money, Nate, David, your audience, your people. I take those people together and I pool all that money together and we go buy a big multi-family property. This thing could be anywhere from 3 to 10 million or more even. And then I have spent the last years dedicated to learning how to have the systems in place, the people in place, the partners to make sure to operate that on a successful timeline so that your investors can just sit back and reap all the benefits without putting in any of the work or dealing with any of those troubles.
And the big advantage, obviously, to something like that is, like you said, it takes a special skill set and you kind of fast track people right to that skill set by being the one to provide it, right? You don't have to go out and learn all that stuff. You already have the experience, the knowledge, the know-how. That's really important. That's awesome.
Yeah, absolutely. And, a lot of people say what I do is that I'm special, that I have this special skill. And maybe I do, but, your audience is smart enough. They could go out and learn it. But the amount of time that it would take and the bloody noses and the broken up knuckles and all that kind of stuff that it'd take to get to that point is a lot of time and energy. So like you said, I like how you said that, is that I fast track people to that end result by letting them leverage my skill set, which is really what multifamily or real estate in general is all about, right? Is leverage.
So there are a lot of terms that get thrown around. We talk about syndications, deals like this, right? Where there's some complexity built in. And I think defining a few of those terms first might help our audience out, especially if you've not listened to some of our past episodes that talk about syndications. So maybe start with something really simple, like the difference between a general partner and a limited partner, or an operator and a sponsor, because those two roles are kind of or four roles, I suppose, are really the kind of the primary things that you're going to see. And understanding where someone might fall into that is really essential to understanding the rest.
Yeah, absolutely. Well, let's start with the easiest one to understand, in my opinion, which is the limited partner or the LP. And basically all that means is that this is the person that's bringing in money into the deal. And the fact that they call it a limited partner is something really important to understand, because your risk as a limited partner is limited to only the amount of money that you put in, which is amazing. Because again, if you go back to the single family house and you go buy one of those, you're taking on all of the risk if something happens at that property. And yes, there are ways to mitigate that risk, and that's not the subject of this episode, but you are taking it on and it's your job to mitigate it. As a limited partner in one of these syndications, that's all taken care of for you. All you have to worry about is your investment. And now the general partner, right? The big difference between that and the limited partner is they're taking on all of that risk and all of that responsibility. They're bringing their knowledge and their skill set into the property to be able to manage all of those processes for you. And so that's one of the big differences between a limited partner and a general partner is general partner is taking on all that risk and all the responsibility. And they, of course, are going to get compensated for that. See, you asked also about an operator. An operator, this is probably, I think it is, the most important person in a real estate syndication. My operator that I'm just worked with recently, fantastic gentleman, his name is Chris. We call him the asset manager, is his official role. And this guy, his job is to make sure that the day-to-day business plan of an apartment complex is happening every single day. So Now, not a property manager, there's a difference, right? So the property manager, they're the ones that are dealing with the toilets and the tenants and all the stuff we talked about earlier. But Chris's role is to deal with the entire global process and make sure that everything that we're telling our investors is going to happen.
And it sounds like a lot of that is because you're not typically just walking in and buying a already turnkey, already running apartment building, but you're generally doing some kind of turnaround, some kind of rehab, fixing management, fixing a problem and driving an increase in value through something like that. Is that right?
Absolutely. In fact, so what I say is that your paycheck is relative to the size of the problem you're solving, right? So my job when I go and I buy one of these assets is to identify those problems. I could tell you some real stories of different things that I've walked into, and I love finding problems and I see something wrong. And that just means that I now have value that I can go to give to my investors. Whether that is a physical problem in the building, plumbing issues or roof issues, or maybe an operational inefficiency, which is my favorite thing. When I find somebody that has owned this property, it's, let's call them really an older person, grandma, grandpa, which nothing wrong with that, but they've owned the property for 20 years and they just don't have the time to treat it like a business, right? They treat it like an investment and it's been paid for 20 years and it's just cash flowing for them. But what they don't realize is that there's this huge delta in the operation that they're missing. Those are the things that I really like to do. So yeah, I find the problems and then I hand them over to the operator to fix.
Well, and then that drives kind of my next series of questions, which is then quantifying that so that an investor can look at this and figure out like, so how does investing in a syndication deal compare with investing in the stock market or investing in my own real estate or investing in whatever that would be? So, things that we talk about in the single family space and some of the small multifamily space would be things like cash flow or cash on cash return or return on investment. I know some of those metrics change, like I hear IRR and things like that in the multifamily space. So what are some of those metrics that you suggest investors look at?
Yeah, metrics are absolutely important. First, you mentioned the stock market. One of the biggest differences in my mind between investing in the stock market versus investing in real estate is the ability to control it or to have the operator that you're working with be able to control it. Who knows what's going to happen with a crazy stock, right? Like if you're following Tesla and Elon goes on some Joe Rogan show, right? You remember that happening. And I just, that's the thing that scares me about stocks, right? Is who knows what's going to happen. With real estate, at least you have somebody that has some control and be able to control that. But back to your specific question about metrics, we still look at cash flow. We do it on a couple of different levels, though. One of my favorite metrics is profit per unit or PPU, right? And so really what this comes down to is at the end of the day, how much money are we making on a individual unit? I have my own metric that I really like to have. I want to make sure that we're making a minimum of $100 per door per unit. Now, that's not always day one, right? But we look out maybe within the first year or something like that to make sure to get to that point. Another one that's really important, you called it ROI. We call it cash on cash return. And really what it is dollars in versus dollars out, right? So you're just for your comparison. So it's simple formula, right? You take the amount of money that you put in, divide that by the amount of money you receive on an annual basis. Pretty easy math formula. Now, something that they have to understand is that typically in an apartment complex, that number can start fairly low, but it builds up over time. One of the last deals that I did, the first year was only 4%, but the 10th year is projected to be at 22%, right? So another one that's really important is the average annual return, or the AAR, average annual return. And really what that is the average of all of those lengths through that time, right? And so if you average all that together on that deal, it was 13% is what that comes out to be. And then you also mentioned IRR. This one's a pretty complicated thing. And if you get into the actual nuts and bolts of it, it becomes a pretty intense formula that nobody can really figure out without an Excel sheet and maybe a couple more calculators outside of the Excel sheet. But really, all it does is it gives credit for the time value of money. Everybody knows about inflation, right? And so dollars today are worth more than dollars tomorrow. And so the faster you can get the money back, the higher the internal rate of return will be, the IRR. So you can typically see something like a 13% average annual return, right? That last one we talked about. And then like a 17 or an 18% IRR. And typically what that'll mean is they have some kind of a refinance built in. So for example, in year 2 or 3, they'll refinance the property and they'll give you a big chunk of money. And so that gives you some of your initial investment back. That gets counted into internal rate of return. The other piece that gets counted into that is the sale at the end. When you sell that piece of property, now that'll also bump up the IRR. So again, it's complicated, but really all it does is it gives credit for when you're receiving the money. Faster you get it, the higher the IRR will be.
Now that makes sense. And that also creates some consistent baseline values for comparing deals against each other. So like if you've got 2 or 3 different projects that are all a little different, someone could compare those. If they're comparing something you have versus someone else's deal, then they've got other metrics to compare there from the quantitative side of things. And we can talk more about other qualitative things and other things as well. But while we're on the topic of some of these metrics and the value of real estate investing, one thing that we've talked about a lot lately is depreciation as well and some of the tax benefits. So are there tax benefits that a limited partner would realize in a real estate investment like this?
Absolutely. So it's so great you bring this up. I just had a conversation with a friend of mine just the other day about real estate investment trusts or REITs and other stock market, quasi real estate investments. And the biggest difference between them and owning an asset directly or through one of these syndications is that you become an actual partner in the property. So you get all of the same benefits as the direct owner. So if the owner gets a tax write-off, you get a tax write-off because, remember, you're a partner, right? That limited partner and general partner. You become a partner in that property. So when there's depreciation, you receive it. Now, I want to make sure to talk a little bit about that and what the biggest difference is between a big multifamily depreciation and a single family depreciation. And one big keyword that you need to talk to your syndicator about, or key phrase rather, is cost segregation. This is one of the most powerful wealth building tools that I have ever found. When you buy a single family property, typically those are depreciated out over the course of 27 and a half years, right? That's a long time. But you have the ability especially with bigger properties, to break out all the individual components of a property. We're talking like, how long does the carpet last? How long does the roof last? How long do the doors last? And now you need a special group of people to put together this study. They need to break it out mathematically, and they use engineering and some really intense stuff. I pay professionals to do just this thing. But what they're going to do is they're going to be able to tell you this portion of the building can be depreciated in 5 years. This portion is in 10 years. This is in 15 years. And you can accelerate all that depreciation. And as a partner in the apartment building, in the multifamily building, you get all of that depreciation on your K1, which is like your W-2 for a partnership, right? Now, I've actually seen people be able to put, let's call it $50,000 into one of these apartment deals and get $35,000, $40,000 worth of tax write-offs in year 1. Now, guys, I'm not an accountant, and I'm definitely not your accountant, right? So, disclaimer here, right? There are rules around how you use that depreciation and what it can be used for and how much of it you can use. So you have to talk to your CPA about that. But it's a huge, huge benefit.
So I'm really pumped that you brought that up, because actually you don't know this, but next week we're going to have a guest on the show that is a professional. They are a segregation specialist that does these studies for people just like yourself. So like we plugged you in that question, you didn't even know it. So I think that's awesome.
Nice. Yeah. That's fantastic. I can't wait to hear it. Do you mind if I ask who it is?
Yeah, CSSI is the name of the company. So they're Cost Segregation Services Incorporated. So they're
very familiar with them. Yeah, they're great. Yeah.
Cool. So that's good. That's a really fun plug. So a little taste of cost segregation and how important it is from Senate here. And again, tune in next week, because we'll have more on that coming up, which is really fun. So I'm glad you said that. That's really cool. So I want to, this is great, right? This is a lot to talk about. There's a lot of detail here, but something I think that helps, especially us detail-oriented pharmacists, is an example. So maybe can you walk us through a recent example of an investment that you've gone through, and just a brief breakdown of how that looks and operates and what that might have developed like?
Yeah. I think there's one that I actually really excited to talk about. We just finished it just now. Actually, just last week, we closed on it.
That's awesome.
So we bought a 33-unit apartment complex in Pocatello, Idaho. It's where it's at. It's a fantastic place to invest, which is one of the first things you should look at in investments, where it's at, right? And know why the operator and syndicator is so excited about that area. Pocatello, Idaho is roughly 2 hours north of Salt Lake City, an hour south of Idaho Falls, Idaho, and then about 3 hours, depending on how you drive, three and a half to 4 hours from Boise. So it's a tertiary market from three great areas. It's booming really, really quickly. It's growing very fast. There's a great hospital system there. There's an FBI data center there, several large industries, very diverse employment. So when I found this opportunity, I knew it was something I had to move on. And so what it is, it's a 33-unit apartment complex. We bought it for $3.3 million. We're going to put roughly $300,000 into it. So for the detail guys, math, that comes to $110,000 a door, all in. That's with our remodel. Now, the nice thing is, going back to those cash-on-cash returns and everything that we talked about, right? So we're going to pay out our investors a 13% average annual return. It's a pretty solid number. If you look at the stock market average over the last 10 years, it's significantly less than that. This year, it's even more significantly less than that. But that's not fair judgment, right? But the plan is we're going to do a refinance in year 3, and we are going to give our investors back 60% of their money. So if somebody puts in $100,000, they're going to get $60,000 back. Nice part about that is now they only have $40,000 in the property. They can take that other $60,000 and go invest it somewhere else, but they still own the property. Now, our cost segregation specialist that you guys are talking to, ours is telling us that we're going to deliver roughly $80,000 worth of tax write-offs to our investors year 1. That's epic. So basically, they're buying $80,000 worth of tax write-offs for $100,000. It doesn't always work that way. Every deal's different, right? Now, we're going to hold the property for 10 years. Over the course of that 10 years, we're going to deliver back 2.7 times the investor's money. So that $100,000, the total return to the investor is $271,000, plus all the depreciation over the course of the time. We're going to sell it in year 10 and hopefully have other properties to hand our investors at the same time. This deal, the reason it was so good was not because there was a big problem physically with the property. It was all mismanagement. The average rent on this property for a 2-bedroom, 1-bath was $610 a month. There are 10 month-to-month leases. We're going to immediately move to 800. Like May 1st, they're going to be 800 a month, from 610 to 800 in that short amount of time. Within 18 months, we'll be averaging about $950 a month. All operational inefficiencies. We're also going to put in a thing called RUBS, which is ratio utility billing. This is an amazing thing. In single-family houses, people pay their own power bill. Well, typically not in big multifamily. Sometimes they're on one power meter. Especially common is one water meter. And then you've got trash services, things of that nature that the owner typically pays. What we do is we institute the ability to break that out based on the square footage of every unit. And then we bill back the entire usage back to the tenants based on that square footage. In other words, this becomes now a pass-through to us. And one of the best things about multifamily is the value of these is based on the income. So if we can take something out of the expenses, now the net operating income, or the NOI, goes up. So we're forcing value left and right on this property. Very excited about it.
That's a great example. I appreciate you walking us through that. Wow, that's awesome.
Yeah.
I'm curious too with the $300,000 in rehab. I know one of the things that we talk about a lot with investors that jump into the single family space is, they go in and they fix up a property. You're saying this is predominantly mismanagement, but it sounds like you're also sprucing the price up a little bit.
Yeah, roughly 10%, which those are all really light rehabs. We're going to put in some new floors, a little bit of paint. The windows all need replaced, which is probably the biggest expense that we're going to face. However, this is going to save power for our tenants. It's going to make it look better and allow us to charge more rent. But yeah, almost every window in it was cracked a little bit, or a little spider web in the corner or something like that. They're old aluminum windows, single pane, and just really drafty. So it's going to make it a much more comfortable place to live.
One question I have too, if I'm a limited partner in this deal, right, and funding's already closed, like this one's gone, but just
thanks for clarifying that.
Yeah, no, but for those that are in it already, right? You say a 13% return. Is that guaranteed if I'm a limited partner? And on the flip side of that, if you get 16%, like, do I see that extra 3 or you get to keep that? I guess that's, if I'm a limited partner, I would want to understand how that works.
Yeah, thanks for asking that question, because there's some really nuances that we need to explain to really break that down. So this property, and again, every property is different, but this property, we're giving our investors what's called a 7% preferred return. What that means is that the investor gets the first 7% before the general partners and sponsors, and before those people make any money, they get the first piece. Now, that's not guaranteed, but we're going to make it up. So if we fall short the first year, if when we go do that refinance or when we do the sale, we're going to go back and retroactively make anything that was missed up. So is it guaranteed? No, but the chances of not getting the 7 are pretty slim.
Got it.
Now, anything above the 7, we split that with the investors. And so the 13 is what's expected. So if we get 12, yeah, they're only going to get 12. But if we get 15 or 16, they're going to share in that just like they would at that 13 number. So the reason that that's important is because we're incentivized based on that same success metric, right? And I have money in this deal too, right? And so my money's in there, so I'm going to get that same 13% return we talked about. It's very important for that to succeed for me as well as the limited partners.
Now that makes really good sense. I think that helps to convey confidence to an investor when they know that you've also got skin in the game too. So you don't want to see this drop. When it comes to the value and the return, it sounds like a big part of that is that refinance at year 3 and then the sale at year 10 and making sure that you hit those. And I know that if looking ahead, my crystal ball is a little cloudy, right? Like I don't know quite where the market is going one day to the next. So as we look at things that we are seeing right now, like we're seeing interest rates go up. Interest rates have a tendency to drive cap rates, which can drive value. Interest rates can drive the refinance at the 3rd-year mark. So how do you predict and then shift strategy as some of those market conditions shift to make sure that investors are protected in a partnership like this?
There's a lot to unpack in that question. So let me first tell you, I spend a lot of time monitoring markets, and I've got people that I trust and professionals that I lean on that tell me what is happening and what their crystal balls may be a little clearer than yours and mine, right? Now, nobody knows for sure, but we have a lot of advisors, like I said. And we don't always stick with the same game plan when we go into a deal. Let me tell you another story about that same 33 unit that we talked about. We started originally looking at this property. It was still warm. So it was at the tail end of winter. So we're going to call it 4 or 5 months ago is when we really started looking at this. And we planned on doing what's called a 3-year bridge loan. And so what that means is at the end of year 3, we had to pay that loan off. Now, whether that's through a refinance or sale or pull it out of our pocket and pay it. But it was a great loan where we had what's called an interest-only payment. We don't have to pay the principal on the loan. So the payment was significantly lower, which allowed us to have higher returns in the beginning of the deal. But that allowed us to also flex our muscles and flex the business plan a little bit more aggressively because we'd have some more income. The challenge is what you just said, the interest rates, they're a little scary. They're going up. And I don't know for sure what's going to happen in 3 years and what that's going to look like. So we decided that we needed a plan B. And so we started shopping for multiple other lenders, and we actually found a local credit union that gave us a great rate. We actually saved a 1/4 point percentage and gave us a 10-year time frame on the note. The drawback is instead of getting 3 years of interest only, now we only have 1 year. That gives us that first year to flex the muscles and get that business plan into place so that it's going to pay for itself going forward. We can do it, no problem. Like I said earlier, I've got a great partner that's going to make sure that this executes properly. But because of the debt problem, we had to pivot to something better. Even though we had a better or a lower payment in the first option, the risk just wasn't worth the reward.
Yeah, I think that makes really good sense. And I like hearing that too, because I think for a lot of investors that are used to buying the single family house and a 30-year conventional typical mortgage, like this whole concept of a balloon loan that becomes due in full in a very short number of years, like if you have to pay back multiple millions of dollars in 3 years, that can cause some heartburn, right? So I think that there's your approach of having a backup plan, I think fits well with the risk averse, safety oriented pharmacist type that we all are. So I like
Absolutely. I try to go into every deal with at least 2 exit strategies, preferably 3.
You mentioned exit strategies. What about, again, I'm thinking someone listening to this that says, I want to be a limited partner in one of these deals. Like, what are the exit strategies that they have, right? As a limited partner, can I jump out of this deal if I don't like it anymore? Or is this like a team sport? Like we're all in it together. And if Senate's 3-year plan is it, like I got to stick with it. How does that work?
Yeah. So, there's lots of pros and cons to these types of investments. And one of the cons is they're illiquid. It's also one of the pros, I believe, truthfully. I'll tell you that story in a minute, but that's why they get such stable returns. But they're hard to get out of. Now, they're not impossible. So it's important to make sure that you know the operator you're working with and that you understand the contract. So for example, my deals, this one that we just did, we will allow someone, if they need out of the deal, to come to myself and the other general partners and have the ability to be bought out. Now, are they going to get the full rate of return at that point? No, absolutely not. They're going to do it at a discount. So the best time to do it is when we do the refinance, because now we have an appraisal. We know exactly what that property is worth, and we can calculate exactly what their investment is worth. But the challenge is the partners have to have money.
Right.
And what if we just did a deal and we don't have money either, right? So it is possible, but it's difficult to get out of.
Gotcha. So there's exit ramps along the way, but they might be under construction.
That's great. I love that analogy. I might have to steal that.
Take it and steal it. Go for it.
So I think one of the things that we're finding in this is we talked earlier about those quantitative factors where you can compare deals against each other, but it sounds like there's a lot of other factors in there, like you mentioned, the geography and the property type and where you think the market is going. I think that one that we haven't hit on real thoroughly is, as you look at that deal itself, is who's running that deal, who is the syndicator, who is the operator. So what advice would you have for someone that is trying to evaluate a deal and trying to evaluate the person offering the deal?
Yeah, that question is probably the most important one that you've asked all night long, because at the end of the day, the person running the deal is really what's going to drive the success or the failure of the operation. I've actually said for a long time, I bet on the jockey, not the horse, because, a good operator can take an average deal and knock it out of the park. But a bad operator can take an amazing deal and drive it into the ground. So I would spend the majority of the time looking at that and asking the operator about their background, their experience, but more importantly, what are their values? Do you like them? Because you're going to become their partner for 5, 7, 10 years. And so you have to, at bare minimum, read their emails and get on calls with them and be aligned with them. So I would say the first thing is, if you can't sit down with the guy and go to dinner, guy or gal, and go to dinner, have a drink, would you invite them to your house for a barbecue? First rule of thumb, right? Got to actually make sure that you're going to get along with them. After that, I would check into their experience. Where do they come from, right? Do they have experience? Do they know what they're doing? That doesn't mean that a new person can't be successful, right? But if they're new, I would ask things like, who are your coaches? How did you learn? Who's your backup? Those types of things.
Yeah, I think that's super helpful because I think, again, just listening to this, right, people are going to get inspired. They're going to be interested in tracking somebody down or figuring out if this is a good fit for them, especially those that are looking for a lot more passive income, right? A lot more passive investment where they don't have to learn how to be a landlord and deal with all those pieces. So I think that's great. And it actually leads me to some of my final thoughts here. And that's, if I'm a new investor and I'm thinking about doing a syndication, where can I go to learn a little bit more? Or what are the things that I should be doing as I start down that road?
There's a couple of really good resources out there. Your podcast is great, right? So hopefully they're already listening to it, right? But there's the great book that I like. It's called Passive Investing Made Simple. This really kind of explains all of the different terminologies and technologies like you talked about. You asked about cash on cash, waterfalls. But I would say Bigger Pockets is another amazing resource. You can get on there. You can ask for references and referrals. Or just reach out to me. I know several of them. I am one, but I also have no problem pointing you in some other directions. If I'm not the right fit, I've got plenty of friends in this space that could be the right fit.
Perfect.
Then I guess our last question for the night is, where can people find you if they want to learn more about you, if they want to ask you some of those questions? Like, how can people connect with you?
I'm a pretty easy guy to find. My website is my name. It's SenateEskridge.com. I'm sure you'll put it in the show notes, but it's spelled exactly like it sounds. Senate, like a senator. Eskridge. It's pretty easy to if you Google me, I come up all over the place. So hit me up. You can email me on there. You can even schedule a meeting on there if you look hard enough. So
perfect. Well, Senate, seriously, thank you for coming on the show and walking us through what is a very complicated topic, but a very important one for our audience to understand. And again, not an area that we get to go to very often. So really appreciate you spending the time with us just to walk through it.
Yeah, absolutely. I had a lot of fun tonight. I enjoy talking about real estate. It's one of my favorite things to discuss. So if you have any more questions anytime, I'd love to come back again. And if anybody from your audience wants to talk, have them reach out to me. I'd be happy to help them, even if they're not going to invest with me. I'd be happy to help them.
We'll be sure to do that. I'm sure we'll have you back on the show in the future because it's always great talking to you.
Excellent. Thank you very much.
Thanks so much.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.